The material we're looking at today is a very detailed analysis report. It's titled The 1500% Forecast, Why Treasure Global, that's TGL, is Skyrocketing. It's all about that huge stock surge after their pivot to fintech. Let's just jump right in. To elevate the robustness of this high-risk assessment, the analysis must spend more structural time establishing the qualitative foundation for the projected 1500% revenue growth. So as I understand it, the core argument is that the stock is being repriced based on this new guidance. They're projecting, about $3 million in revenue for the rest of fiscal 2026?
Right.
And it's all driven by this pivot to a digital asset and fintech ecosystem, specifically the Oxy wallet and this RW tokenization stuff.
And the analysis makes it clear that this is just what the company claims it will be, which is a good start, but I wonder if we've considered that the analysis, as it stands, presents that $3 million forecast and the whole pivot. Well, it's presented largely as an unsupported premise.
Like it's already a fact?
Exactly. It's treated as a given, not as this immense, incredibly difficult hurdle they have to clear. I mean, because the entire thesis, the whole 1500% number, rests completely on the validity of this leap of faith. The analysis feels unbalanced. It focuses so intensely on the effect, the wild stock price move,
right,
but it doesn't adequately scrutinize the cause, the actual operational viability of this brand new fintech model they're switching to, coming from what was, let's be honest, a struggling rewards platform.
I agree. It really does feel like it's treating that $3 million number like it was handed down on a stone tablet, not like it's a wild projection from a company that just completely scrapped its old business model.
Yes.
The gap between their past performance and this future claim is just monumental.
It is. And that's why the analysis needs to integrate specific, tangible benchmarks, things that actually give some credence to the idea that the Oxy wallet and RWA initiatives can be commercialized immediately. This is how the piece moves from just, reporting what management claims to critically analyzing if it's even feasible, which is absolutely essential when you're looking at this kind of volatility.
Okay, but how deep do we need to go? I mean, the person using this is interested in the investment opportunity. Do we need a whole section modeling the new business, or is it more about just adding strategic context?
It's about strategic context that supports the number. We have to see the how. How do they get to 3 million? So, a few possible ways to strengthen this. First, detail the expected transactional volume for the Oxy wallet, or maybe minimum viable product targets they have to hit to even get on a $3 million run rate.
Okay.
If they need 100,000 active users by Q3, that context needs to be in there. Second, examine the specific market they're targeting for RWA tokenization. Compare their projected take rate against competitors who are already successful in that space. And third, if management released any other info, partnerships, onboarding pipelines, maybe regulatory hurdles they've already cleared, those details have to be integrated. They're what bridge that massive credibility gap.
So you're basically saying the writer has to do the due diligence for the company, mapping out the actual operational steps. Otherwise, the whole thing just feels like conjecture.
Exactly. It shores up the core assumption.
That inherent instability leads perfectly into our next point. The structural relegation of the bear case risk section to a closing summary point really dilutes the critical angle of the analysis, especially since this move is, it's fundamentally driven by pure speculation. Okay, so what I do like here is that the analysis clearly identifies the extreme volatility. It explains that this is a classic show-me story and that the market is pricing imperfection on the new guidance.
It does, but is there a risk that by focusing so much on the skyrocketing headline, the big 700% move, that it overshadows the fragility that's baked into that very phrase, pricing imperfection? By saving all the risks, the volatility, the pullbacks for the very end, the analysis misses a huge opportunity. It could be using skepticism as a primary narrative driver, not an afterthought.
Right.
For a pure momentum play like this, one that's based almost entirely on hope, the counter-arguments can't be separate. They have to be woven right into the fabric of the growth story itself. It just provides a much more sophisticated view.
I hear you. But the report is titled The 1500% Forecast. If the writer leads with a lot of heavy skepticism, won't they risk confusing the reader? Or, undermining the exciting part that drew them in? Isn't the point to explain the move up?
I think the suggestion here is to frame the analysis not just as an explanation of why the stock is moving up, but as a clear warning of how conditional that upward movement is.
Okay.
That strengthens the report's credibility. It shows the analysis isn't just suffering from confirmation bias toward the big bullish headline. It tells the whole story. So, for example, one way to do this, right after presenting that 1500% growth figure, introduce a dedicated section. Call it something like the execution hurdle or the credibility gap.
I like that. So how would that section work?
In that section, you'd use the historical revenue of the old ZCD platform as a direct, almost brutal counterpoint to the new guidance. It forces the reader to confront the size of the task ahead. Another way is, instead of just saying, "This is a show me story," you rephrase the whole central question of the analysis.
How so?
You ask something like, given the market's total dismissal of their past performance, what is the maximum sustainable downside if this pivot misses expectations by even a little bit? It's a much more useful question for an investor. And then you use the low float context, which we'll get to, not just to explain the surge, but to explain exactly why that volatility cuts both ways.
And maximizes the downside risk.
Precisely. That shift in framing is what elevates the whole piece.
Absolutely. It makes the report resilient. If the stock tanks, the analysis is still relevant because it already framed that exact scenario. Now, let's look at that final piece, the market mechanics. The material highlights that the extreme 700% volatility is caused by technical factors: low float after the 1-for-20 reverse split, demand just overwhelming supply, short squeeze potential.
Yeah, that description of the mechanics is accurate, but the analysis, it currently treats the low float and the 1500% catalyst as two separate events that just happen to coincide.
Like a coincidence?
Right. The weakness is that the report doesn't fully connect how the technicals aggressively magnify the fundamental uncertainty of the show me story. The link between A, the unproven forecast, and B, the extreme technical distortion. It's just presented descriptively, not judgmentally. And that's a critical missed opportunity, because in a situation like this, the mechanics are the risk.
So the core message is that these technical factors aren't just benign explanations for the move.
No.
They're what could make the downside truly catastrophic?
Precisely. The analysis has to delineate that these technical factors are the mechanisms that transform the risk of the forecast being missed into potential catastrophic volatility. This sharpens the advice for anyone using the report for trading decisions. It emphasizes the asymmetrical risk.
Okay, so this sounds like we need to be very explicit about the danger of that low float. How do we make that connection absolutely clear for the reader?
A few actionable steps. First, explicitly state that the reverse stock split created a low float, which means the market is trading on a minimal, historically unstable data set.
Not a strong foundation.
Not at all. And that lack of liquidity is what makes the price so susceptible to just pure narrative, not fundamentals. It's why it moves so violently to begin with. Second, when you discuss the short squeeze potential, which is a huge draw for momentum traders, you have to immediately transition to the risk of a long squeeze, or a rapid technical correction.
Wait, can you just clarify what a long squeeze looks like in a low float scenario? Is it just a fast sell-off, or is there something specific that makes it worse?
Oh, it's the dynamic that's the killer. In a stock like this that's run 700% on news, a long squeeze happens when momentum suddenly reverses. Because there's so little liquidity, when the early traders decide to take profits, there just aren't enough buyers to absorb the selling.
The price just collapses.
It drops like a rock, and that triggers margin calls, stop losses. It's a cascade. It happens so much faster and more brutally than in a stock with deep liquidity.
Okay, yeah. Introducing that concept brings essential balance to the technical risks. That's the key piece of information.
Exactly. And finally, let's look at that closing thought. The analysis ends with, watch the $60 level. If it holds, the hype is real. If it breaks, watch out below.
It's punchy.
It's punchy, but it needs to be tied directly back to the liquidity constraints of the low float. You have to explain that in this specific environment, price discovery is hampered, so these technical levels are way less reliable as support than they would be in a normal stock.
So you're reinforcing that the price levels are more psychological than structurally sound?
You're confirming that the technical structure is built on quicksand, not solid ground.
That's a fantastic way to conclude the body of the report.